I think I've done a woohoo for all these videos so far. Maybe I'll change it for the next one. I don't know. Who cares? Monetary policy, public finance, debt ceiling, part 3. Yeah. So, we left off that last video where I asked you what you thought the United States operated as, whether it was active fiscal policy and passive monetary, or active monetary and passive fiscal policy. And the answer is, drumroll please, active monetary policy and passive fiscal policy. That's what we currently have. Because essentially, right, the monetary authority can do whatever the hell it wants. If the fiscal authority wants to spend a bunch of money and expect the monetary authority to bail them out, well, too bad. The monetary authority doesn't have to. That is also what's known as the independence of the central bank. Now, there have been a lot of debates over the years over, one, how independent the central bank is, and two, how independent the central bank should be. I am currently under the impression that the central bank is independent, but maybe not as independent as one would think or would like, or I would like. And the central bank should be as independent as humanly possible, because you don't want think of it as like a check on the powers of Congress, right? If Congress has control over the Federal Reserve, they can spend whatever the hell they want. And all of a sudden, monetary policy is no longer active, it becomes passive. So if you keep the two separated, then you kind of by default have active monetary policy and passive fiscal policy. But enough of that. I just thought I would answer that question really quickly for you guys. Let's move on to, well, more stuff. Yeah. So, big question here. Government debt dynamics. When's the government gonna have to actually start worrying about their debt? Because as of the end of 2020, right, United States GDP was like $20.9 trillion. U.S. national debt was like, I think 26.93 or something like that. More than 100% debt to GDP. 2021, right, the national debt's expected to go up to 28.4 trillion. It means we're set to have another year of the debt to GDP ratio over 100%. Now, you might go like, oh my God, that's really scary. I thought it was scary for quite some time. But in reality, debt to GDP has been over 100% for quite some time in the United States. And it's over 100% in a lot of other developed industrialized nations. So why isn't this a problem, right? I mean, doesn't the national debt matter? You'd think. We owe a lot of money. That's kind of a big deal. Of course that matters, right? Well, yeah, it does. But more complicated than you might think. And it doesn't matter in the ways that you might think. Because yes, the national debt does matter. But like all dynamic issues, it's not just where we are today that matters, but also where we expect to be tomorrow. So in this lecture, we're going to, hold on one second. Isis, knock it off. No, ma'am. No, ma'am. Don't claw that. I don't care how cute you think you are. My apologies. My cat was trying to claw one of the speaker cabinets for my guitar stuff. That really pissed me off. Anyways, in this lecture, we will be doing the following. Yelling at my cat. Yelling at my cat. Applying what we've learned about the different budget constraints. Yelling at my cat. Understanding how debt dynamics of the fiscal authority are governed. Getting angry with my cat because they seem to know that I am busy doing something and not paying any attention to them at the moment. And they are making an ass of themselves, all four of them. We'll also be learning the cases where the government debt is sustainable and unsustainable, and why it's not really as cut and dry as you might think. So we have the fiscal authority's budget constraint, right? This is the combined budget constraint, where we took both the fiscal and monetary authorities, put them together. Now, we want to make a couple of simple assumptions here. More assumptions. Assumptions. We assume that there's no money growth. Why? Well, trust me, you don't want to deal with this when you've got money growth, because inflation becomes a bitch. I didn't say inflation becomes a pain in the ass. No, I didn't. Inflation becomes trouble. It becomes troublesome, worrisome. So we have no inflation here. That simplifies our constraint down quite a bit. So now government spending is equal to taxes plus the flow of bonds, right? And that flow of bonds is the creation of new government debt. Now, we could assume that there's still money growth, but it's very, very, very cumbersome. You don't want to do it. So from our new constraint, we want to express it in terms of BT plus 1 because those are going to be the bonds that we're essentially selling today, right? Because we sell bonds today, like we kind of sell the bond today, and then tomorrow we actually get the money in. So that's why it's BT plus 1, because it's tomorrow. So this is what we get, right? So all I did was just move the tau sub t and the b sub t to the other side of the equation, which gives me this. Now, I want to isolate b sub t plus 1, so I multiply both sides by 1 plus the real rate of interest. And that gives me this right here. So bt plus 1 equals 1 plus the real interest rate times b sub t plus gt minus tau t. Now, as a short little aside, what I'm going to say is that debt creation is given by, right, bt plus 1 minus bt. So if I want to move that 1 plus r to the left-hand side just for a minute, right, I'm moving it back over. So we're going to divide both sides by 1 plus r to get this, right? So what I did was I subtracted, right, bt from both sides. Now there's two bt's on the right-hand side of equation 4, because there's bt times 1 plus bt times rt. Right, so I subtracted that out, that bt, right, subtracted that out, and then I divided both sides by 1 plus the real interest rate. So I've got 1 over 1 plus the real interest rate times bt plus 1 minus bt equals rt over 1 plus rt times bt plus gt minus tau t. Now, it leads a constraint with debt creation of delta bt plus 1, right, of the 1 over 1 plus r times bt plus 1 minus bt being expressed as this right here. So you're going like, wow, dude, you hit me with math last time, you're hitting me with math this time, and I am. So the fiscal authority has to pay r over 1 plus r times bt every period to cover at least the interest payments on its debt. That's like the bare-ass minimum that it's got to pay, right? Think like, the housing crisis. People were getting like these variable interest rate mortgages, and they were just paying the interest on their house. They weren't even covering the principal. Same idea, right? They've got to be able to cover at least the interest rate on the debt repayments. If they can't cover that, well, that's where we now have an issue of insolvency. They can't do that, they're screwed. They are insolvent. They default on the debt, and the economy enters a recession. That's bad. So from this, right, essentially, the left-hand side is telling us debt that's being created every period. Bonds are a state variable, which means the fiscal authority sells BT plus 1 bonds today, and then we get that, we get the money that we can actually spend. Well, tomorrow. It's going to be paid back tomorrow, right? So we get the money today. Yeah, you see how it goes, right? And they've got to essentially pay, because it's like debt they'll be taking on tomorrow. Now, they have to pay an RT over 1 plus RT times BT today to cover the interest rate payments on their debt. So the right-hand side of the constraint tells us the fiscal authority has to cover the interest rate payments on their debt, and the fiscal authority can spend GT, and they can tax tau t. Right, so basically, it is a source of funds and use of funds sort of thing. Right, only the source of funds and use of funds are kind of on either side of the equation here, but again, we still have sources of funds, variables that serve as sources of funds, and variables that serve as uses of funds. So, can the fiscal authority take out debt indefinitely? Nope. So can they take out a debt to a level where existing debt's larger than GDP? Yep. So what gives? Well, to answer that, in short, they can take out debt past 100% of a debt to GDP ratio. It's honestly no problem. There's just certain conditions that have to be satisfied if they want to do so. Now that we've seen what debt growth looks like and how they have to service the debt at a bare minimum in order to be able to get by, let's kind of learn what some of these conditions are, right? So how can we establish if debt growth is sustainable in the United States? Because you always hear that we're taking out a lot of debt. We keep taking out debt, keep taking out debt, and the economy hasn't collapsed. And you get like these total loon bags like what's the guy's name? Peter Schiff, right? I don't know if you know who Peter Schiff is. If you don't, great. If you do, my condolences. The guy is a total loon bag, and he always says crazy stuff like the economy's going to collapse like tomorrow. He's almost like Alex Jones, but like a little bit more sane. And that's kind of not saying very much, right? Um, and so instead of like all these fourth and fifth and sixth dimensional like aliens, and they're working with breakaway rogue government agencies and like whatever that crazy stuff he says, it's more like, well, the Federal Reserve is just monetizing the debt, and they're going to collapse the economy, and then the government keeps spending all this money. We need a balanced budget amendment. That's going to fix everything. Like just crazy shit that just doesn't really make any sense. It would be nice, but it doesn't make sense. It doesn't work in like reality. Just no. Don't listen to Peter Schiff. He's an idiot. So that's one way we can establish if that growth is sustainable. We just don't listen to that jackass. How else can we? Well, if we want to do it in a way that is actually productive and not just yelling at some crazy guy for saying crazy stuff, we have to return to our constraint. So this is our constraint, right? BT plus 1 equals 1 plus R times BT plus GT minus tau. So all that manipulation I did in the couple slides ago where I was talking about like, the debt growth, all that stuff, that was just one particular way to play with it. We're going back to where it originally was, right? So this is what we get. Now we get the evolution of the debt to GDP ratio by dividing everything by output. Why? Well, selling bonds, right? We keep selling bonds. That's going to be debt that we're taking out. And we want to know what the debt to GDP ratio is. So I just divide everything by Y. Okay, that's kind of easy. Just divide both sides by Y. Cool. Well, the left-hand side's in good shape, but the right-hand side needs a little bit of manipulation, a little bit of work. So I'm going to split up the numerators on the right-hand side. Right, so I get 1 plus R times B over Y plus 1 plus R times G minus tau over Y. Right, so you can split the numerator. You can't split the denominators up, but you can split the numerators up just fine. And that's essentially what I just did. I split the numerators up. I kept G minus tau together, but I separated that BT from them. Now, this is where I've got to make another simplifying assumption. From here on out, I'm going to assume that there is a balanced budget, G equals tau. So, right, in equation 10, right, that G minus tau, G equals tau, something minus what it's equal to, goes to 0. So that last term just goes to 0. That gives me this right here, equation 11. BT plus 1 over Y equals 1 plus R times B over Y. Now, I want to think about this in terms of a growth rate of GDP. But right now, all I've got is just GDP and levels. But we've got a dynamic question. And with a dynamic question, really be in good shape to think of it in terms of like a growth rate of GDP. So I'm going to multiply the right-hand side of equation 11 by 1. You're going like, well, Jeremy, dude, WTF. That's not 1. YT minus 1 over YT minus 1. Yeah. That's yesterday's output over yesterday's output. But remember, like anything divided by itself is just equal to 1, right? 2 over 2 is 1. 3 over 3 is 1. Last quarter's GDP over last quarter's GDP is just equal to 1. So if I want to multiply it by 1, which I'm totally allowed to do, who says I can't multiply it by YT minus 1 over YT minus 1? What the hell, right? Doesn't matter. I'm doing this because that's 1. You can literally multiply anything by 1 as many times as you want, and the product is always going to be 1. Kind of cool. So I multiply the right-hand side by a fancy way of saying 1 to get this right here. Now, I can rearrange the denominators here because I can't split them up, but I can change the order of multiplication because it doesn't matter, right? YT times YT minus 1 is equal to YT minus 1 times YT, right? 2 times 3 is equal to 3 times 2. So I'm allowed to do that. Right? I haven't broken any rules yet. So the left-hand side is still the same. I haven't done anything to the left-hand side. The right-hand side, 1 plus r times bt over yt minus 1 times yt minus 1 over yt. Right? Well, now, that yt minus 1 over yt, that's the interesting part, because that's where I can kind of start to get the growth rate of GDP. Now, because I've got yesterday's output, right, divided by today's output. Icy. No, ma'am. No, ma'am. By the way, probably heard me yelling the name Isis earlier. I do have a cat named Isis. She is named after the Egyptian goddess Isis, who is the wife of Osiris. I also have a cat named Osiris. The naming convention of Osiris came first. I had an Osiris the first, and then when Isis showed up, I was like, hey, cool. Osiris is going to have a little friend. Her name's going to be Isis. I call her Icy for short. Also, so it doesn't get me on government watch lists, and so I can still fly. But I name her Icy. Like, I call her Icy, or Isis. Unfortunately, the first Osiris died, and then got a little kitten who was really cool, and he had a lot of similar qualities to the first Osiris. So I'm like, hey, you know what? What the hell? I'll name him Osiris the Second. Right? So he is Osiris the Second, or Osiris II, Egyptian Boogaloo. Yeah, so I've got Osiris and Isis. So I didn't name her after the terrorist group. I kind of wish the terrorist group didn't take that name, because, well, it kind of pisses me off because everyone's going to now think ISIS is like some little terrorist. Although if you see what the kind of damage she tries to impose on, well, a lot of my stuff, you might actually think she is a terrorist. But anyways, moving on. The growth rate of GDP is newer GDP over older GDP equals 1 plus gamma, where gamma is the actual growth rate, right? So a quick little aside. I got yt minus 1 over yt instead of yt over yt minus 1, right? That's the inverse. That growth rate has to be expressed as 1 plus gamma to the negative 1, right? Or 1 over 1 plus gamma, whichever one you prefer to write out, that's what you can write out. But 1 over 1 plus gamma or 1 plus gamma to the negative 1, same thing. So I've got to express the growth rate as 1 plus gamma to the inverse of 1 plus gamma, 1 over 1 plus gamma. So I rewrite the constraint as this. So the left-hand side of the constraint is still the same, bt plus 1 over yt. It's equal to 1 plus r over 1 plus gamma times bt over yt minus 1. Now, here's the interesting thing, right? bt plus 1, it's sold today. So if we take out new debt, that's bt plus 1. But we did it today, so we divide that by yt. And what I've got from last period is bt over yt minus 1. Because bt, right, was sold in period t minus 1. So it's adding to the debt in period t minus 1. So that's yt minus 1. This is what we get. So 1 plus the real interest rate divided by 1 plus gamma. That's the interesting part here. I mean, they're all interesting, but that's the part we're the most interested in at this point in time. So I denote the debt to GDP ratio, right, as, say, dt plus 1 equals bt plus 1 over yt, and dt equals bt over yt minus 1. And that gives me this right here. So dt plus 1, I just did a little substitution just to make things easier, equals 1 plus r over 1 plus gamma times dt. Now, it's the last little bit for us to worry about, except it's not, because I lied. I don't know why I even thought it would be appropriate to try to lie, but whatever. So from this right here, which is just what we had, equation 15, it's also equation 16, cool. We need to think of this in terms of ice. Never mind. It's just using the litter box. Like, good kitty. Not going somewhere she's not supposed to. Anyways, we need to think of this in terms of how it evolves over more than just one period. Because we got like multiple periods in which we need to be concerned about the debt to GDP ratio, like, well, you know, all of them. So I do this. I get dt plus n equals 1 plus r over 1 plus gamma, the whole thing to the power of n times dt. And what that tells me is how debt to GDP will evolve over time n periods into the future, and whether the right-hand side will converge or diverge as the number of time periods goes to infinity. So, from that guy, we've got equation 18, there are three possible cases. The first case is where the interest rate is less than the growth rate of the economy, in which case that happens as n approaches infinity, right? As we go further and further and further into the future, d sub t plus n will approach 0. So as n approaches infinity, d sub t plus n converges to 0. This is a convergent case. Now, when it's convergent, that is sustainable debt. So we're good in that case. Why is that? Well, it's because that fraction, 1 plus r for 1 plus gamma, is less than 1. So, right, anything that's positive but less than 1, if you raise it to higher and higher and higher integer powers, that product, d sub t plus n, is going to get smaller and smaller and smaller. So, case 1 is convergent. We're good. Because if it converges, right, if the debt to GDP ratio converges, it's sustainable debt growth. We're fine. If the interest rate is equal to the growth rate, right, d sub t plus n is constant over time, we're good. It's sustainable. Not the best thing in the world, but it's sustainable, so we're good. Now, case 3, this is the dangerous one. The interest rate is greater than the growth rate. D sub t plus n explodes over time. So the debt to GDP ratio just keeps getting bigger and bigger and bigger. Debt to GDP diverges. And as time goes on, debt to GDP just gets larger and larger and larger. That's what divergent means. So this is unsustainable. This is bad. And the fiscal authority eventually has to default on its debt. And we've seen this before, right? We've actually seen this in your lifetime. The sovereign debt crisis in Greece in like 2010, 2011, right? That was a situation where debt to GDP was just getting bigger and bigger and bigger. It eventually became unsustainable, and they couldn't even make interest rate payments on their debt anymore. It was bad. So which one do you think we're in right now? Do you think it's case 1, case 2, or case 3? Now, it would be cool, right, if I was like, I'm going to end the video here, just chop it off. God, I sounded like Alex Jones again. If I was just like, you know what, I'm going to end the video here, chopped it off, give you time to think about it. But, you know, not going to do that. I'm going to, like, M. Night Shyamalan, I'm just going to totally, like, spoil the surprise ending here. If you just give me one moment to scoop out my cat's litter box because it smells really bad in here. So I will need about 5 minutes, and you will only know that I'm gone for, like, 2 seconds. And I am now back with a much more pleasant aroma, much more pleasing odor penetrating the air around me. Okay, cool. So, which one do you think we're in? Do you think we're in case 1, case 2, or case 3? Well, I'm going to let you know right now. But to let you know, we kind of need to do an exercise. Because I'm not just going to, like, give you the answer, right? You got to, like, sit through it. You got to, like, work through it with me. Because that's the point of teaching, right? It's, like, the beauty of school and stuff like that. So we need to think if there's a metric in the real world for debt to GDP, the real interest rate, and the growth rate of GDP. Fortunately, we can get all three, so we're good. Now, here, what I'm going to be concerned with is R and gamma. So we need to think about what we should use for R, right? There's a lot of interest rates out there, right? Even if you look at just the interest rates that we should consider using, like, you know, interest rates on government debt, there's still a lot. Now, we need to use a real interest rate, which makes it even more difficult because then it's like, okay, what nominal interest rate do you use? And then what inflation rate do you use? Oh, God, sucks. But we need a nominal interest rate minus inflation. Now, if we averaged out, say, the 10 and 20-year treasury yields over the last, like, I don't know, 30 years, we would get about 4.35% per year. And the inflation rate has averaged at about 1.82% per year. Cool. So that's one thing that we can use. We can use, like, the nominal interest rate on some of these government debts. If I do 4.35 minus 1.82, I get 2.53%. Right, so that would be R in this case. Now, another option would be to use Treasury Inflation Protected Securities, or TIPS. Now, if I were to average that over a similar time period, we get about 1.68% per year. And real GDP per capita is 1.68% per year. And with a growth rate of the population at about 1%, well, I'm going to add those two. So I get about 2.6% per year. So in every single scenario here, right, I get the real interest rate is less than the growth rate of the economy. So the interest rate has been, even including 2021, or really as much of 2021 as we currently have, because we haven't made it all the way through 2021 yet, but up to even where we are in 2021, the interest rate's been bounded by GDP growth. So by the metrics guided by our theory, right, it would appear that we have sustainable debt growth. Cool. So we don't have to worry about the government defaulting. Well, not really. Is it something that we should always be concerned about? Yeah, of course, right? Just like you should always be concerned about how much you're spending, like on your credit cards, right? How much debt you're taking out, how many loans are you taking out? Like those are things you're gonna have to worry about because, well, your finances are important. They matter. Just like for the government. Now, the government may not be that bright in how they're doing some of this stuff. They're spending a lot of money that they don't have, but, right, given the computations that I've just chugged out, it's at least sustainable, right? Even in the scarier situation, it's still pretty freaking sustainable. So R is greater than gamma, or less than gamma, I mean, not greater than, right? GDP growth is higher than the interest rate in all these scenarios. So yeah, okay, don't have too much to worry about. So we can, to wrap everything up, or everything this far up, we got one more lecture after this, but to wrap up stuff this far, debt to GDP can be over 100%. We've had it for actually a while in the US. But the growth rate of GDP has to exceed the real interest rate on that debt. As long as that's the case, debt growth is stable. Think of it like this, right? Can you take out more debt than what your income is this year? I mean, you could. Probably not very wise, but you could, right? You might have more college loan debt than what you're earning right now. Hell, when you get all grown up and go out and like buy a house, chances are, right, unless you're like this crazy rich millionaire, chances are when you buy a home, that home is going to add a lot of debt to your name, probably more debt than what you're earning on an annual basis, right? So sure, you can take out debt on your income. Now, if you're buying a house, okay, maybe it's a slightly wiser option than what, I was initially kind of saying. But to do it often is definitely not very wise. But if you got college loan debt, I got a lot of college, like student loan debt. It would make your head spin like that chick from The Exorcist. You knew how much my student loan debt was. Scares me. I got to start paying it back soon too. Damn. Anyways, yeah, my student loan debt is currently a good bit higher. Not a lot, but a little bit higher than what my annual income is. So I've got more debt than what I'm earning, but you don't see me declaring bankruptcy because I don't have to. Why? Well, according to this theory here, right, I can pay it off. And I can at least meet that bare minimum in which the interest rate on the debt, on my debt, right, is exceeded by the growth rate of my income. Right? So the best way to make sure that you can pay this stuff off is to have your income grow every year and to have the interest rate on your debt be less than what your income growth is. So you can at least cover the interest rate payments on your debt. Now, if not, you can't make it and you're screwed. But the government's really the same way, right? And honestly, it's even more binding for the government because, okay, let's assume you earn, I don't know, like $120,000 a year and you owe 50,000 or okay, you owe $130,000, right? You make 120. Now, you've got some, I don't know, 5% interest rate or something, right? Your income can keep increasing and you can keep spending, like, paying off your debt, no problem, right? Or you can just sort of chip away at it little by little. But for the government, it's a little bit different. So the idea, though, the general concept, the gist of it all, right, is kind of the same. You want to make sure you can at least make the bare ass minimum payments on your debt. So the best way to wrap up the debt dynamics discussion is by just saying this one thing. Politicians are stupid. They're not too stupid. They know exactly how much stupid stuff they can get away with before they get fired. And when you fire politicians, because you vote them out of office. So if they do anything that's too stupid, they know they lose their job. They don't do anything that's insanely stupid. They can keep their job. So politicians will spend a lot of money. They'll spend way more money than what they should and what we have. But they understand the limit, because if they push that limit, they're out of office. So their own rational self-interest keeps them in office. So anyways, that wraps up this stuff. So we learned basically debt dynamics, when debt growth is sustainable, when it's unsustainable. And the last thing we're going to learn about is this neat little concept called Ricardian Equivalence. That will show up probably in a day or so from you watching this video. Well, if you watch it the day it gets released. If not, you could be watching it 30 seconds later, because it's, like 2 days after or whatever. Enough of me talking. Anyways, yep, enough of me talking. So, bye.